Did we just put in a bottom? Stocks, commodities, and cryptos all rallying in unison, risk assets outperforming while defensives taking a back seat. And all it took was a single day without a tariff headline. And with a government shutdown averted, things are looking far brighter today than they did yesterday. So what will stocks do next? The game plan is actually very simple. Today we're going to break it down in granular fashion. I'm going to tell you exactly what the S&P 500 will do next week, starting with Monday as our baseline. Uncertainty has ruled this market, and next week we have the March FOMC, as well as the Fed's statements of economic projections. With how muddy the macro has become, the market will react violently to every word from Powell, and any surprise should be expected. With inflation data still looming large, traders on edge, will the Fed signal a pivot or double down on their current stance? Either way, expect fireworks as the market hangs on every single word. So how do we trade this volatility, or is this the end? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks bounced back sharply on Friday to cap a volatile week on Wall Street as the risk of a government shutdown eased while investors stayed on watch for the next move in the escalating trade war. Mega caps rallied, the broader market rallied. It was a pretty green day. We're looking like we're trying to put in a bottom here in the market. Nvidia up 5%. The stock is up, I think, 10% this week in the last 2 days as well. Absolutely crazy move. Apple gained nearly 2%. AVGO, hardware, software. It was a bull run everywhere, except in two sectors. Communication services here was largely red. AT&T outperformed, but T-Mobile and Verizon underperformed the broader market. And then a couple of names here in the staple sector, stuff like PGKO, these quintessential defensive stocks, they were in the red. That was pretty much it. Every sector was green, subsectors were red. The SPY gained more than 2%, and the worst performing asset on this chart was actually gold. So it really goes to show we definitely did have some risk on moves today, with technology, energy, financials, discretionary, highly cyclical sectors outperforming the likes of healthcare, staples, materials, real estate, these defensive sectors. But every sector was green, and it was really just a gap up and go, making higher highs, higher lows, pretty much all sectors finishing at their highs for the day. And it wasn't just large caps, small caps, mid caps, value growth, core, everything outperformed. Look, large cap growth was up nearly 3% today, but so too was small cap growth, and small cap value also performed. Today was essentially just buy the dip. There was a lot of money sitting on the sidelines, a lot of people had sold, sitting on cash, and Friday was the day to deploy it into the market. There was a couple of reasons why we saw this massive green momentum. The first was actually the economic data for this week. The economic data was actually really, really good, and we reported on the fact that it was good. Jolts came in better than expected. Same with the quits rate. It actually rose. That's a sign of work confidence. Core inflation came in significantly cooler than expected. Both the headline core month over month and year over year figures. And I think in the next inflation print, this is actually going to cool significantly as well, further helping the Fed. PPI came in cooler than expected. Michigan consumer sentiment missed expectations today. However, there is a ton of politics in the sentiment survey, and it's one reason why I don't pay a ton of attention to it. Another reason was that the Senate advanced the funding bill. 10 Senate Democrats joined with the Republicans on Friday to advance a 7-month government funding bill, avoiding a government shutdown. It simply just means that uncertainty is now officially off the table, and we can continue with our regularly scheduled programming. But I think the biggest reason why we actually saw a move today was that there was actually no tariff headlines, no major tariff headlines. So days without a tariff headline is officially at 1. That is a big reason why we actually went out and rallied today. We just had a lot of certain things. Good economic data. We avoided a shutdown. No tariff headlines. I mean, that is all going to rear its head in the market, looking very, very bullish. Now, there were a couple of big winners, big market movers. Ulta Beauty up 13% After it surpassed expectations in its earnings, Ulta announced earnings of $8.46 per share and revenue of $3.49 billion, exceeding analyst forecasts of $7.12 per share and $3.46 billion in revenue. And if you want the full earnings update for Ulta Beauty, go into my second channel, FinFluential Media. I did a full deep dive into Ulta Beauty's earnings, so you guys can go check it out. I'll leave a link in the description or in the comment section. Another market mover today was Tesla. Tesla gained 3% today, but it was very, very volatile. Number one, Tesla warned that tariffs could definitely hurt its operations and urged the US to rethink its policies. The stock to start the day was up 3%. Then it actually fell nearly 6%, right? And then Tesla came out with a report that it's planning a lower cost Model Y for the China region. And as a result, the stock rallied and we finished up nearly 4% on the day. Very, very volatile trade here for Tesla. But net, it did help the markets move in the right direction. Still about 45% of its mid-December highs. DocuSign was up 14% today after the electronic signature company beat earnings and revenue estimates and more customers adopted its artificial intelligence offering, meaning they did raise guidance. DocuSign was up 14% on the day. It pretty much had a gap up and then traded sideways for the day. So the majority of the move was in the morning, but still this will probably support the stock to hit that $90 region before the next quarterly earnings. Market breadth was fantastic today as well. 4,800 advances, 1,400 decliners, and we saw net inflows from the get-go, making higher highs, higher lows. The S&P 500 up 2% on the day, but very strong net inflows for both the Nasdaq 100 as well as the New York Stock Exchange. Is the type of stuff you want to see. All rallies backed by volume, backed by net inflows are very strong rallies. And we'll see if the market can keep up this momentum. But what we did do today was retake the 5-day moving average. It surpassed the 50% mark, and this is how it starts. It starts with the shorter term moving averages, goes into the medium term moving averages, and then goes into the longer term moving averages. Ultimately, we can see an escalation and a regain of maybe the 20-day and 50-day next week. That is really going to set us up, continue the move back to those all-time highs. But we'll take it one step at a time. We've regained the 5-day moving average, and that is a very big win for the bulls. We also did see incremental improvements here in all of the moving averages, shorter term, medium term, and longer term averages, and that is exactly what you want to see. Now let's dive on the chart, and these are the major gauges right here: the IWM, the Qs, the S&P 500, the RSP, and the Dow Jones. Now, as you can see right here, all of the major equity indices were deep in the green today, and what we really saw was they were green in a week that was pretty red. The S&P 500 fell 0.76% for the week. The Qs was down half a percentage point. The IWM, actually the outperformer, up 0.21%. The RSP and the Dow Jones, the two worst performing indices, down 1.64% and 1.95% respectively. You can see that here early on in the week, we actually had a big slide on Monday, and we actually tried to put in a recovery here early on Tuesday. However, that did not work out because we actually put in a lower high and then actually made a lower low, and things were looking very, very grim for the market as a whole. In some cases, looking at stuff like the Dow Jones and the RSP, down nearly 4% for the week. This is going into Thursday. Thursday's low 4%. Things looking very grim. Stuff like the S&P 500, the Qs, and the IWM down about 3% for the week. So a brutal week for the week on Thursday. However, we did pair some of those gains, and it was very, very positive because in the S&P 500, the Qs, and the IWM, a lot of these indices, we actually broke out and retook some of these highs we made here earlier on in the week, which means that we can now go target last week's highs, right, that we had here on Monday. That's very, very positive. We didn't see that same sentiment in the RSP and the Dow Jones, meaning they have a little bit more work to put in next week if this rally is to materialize into something more and it's not just a dead cat bounce. We really need confirmation on Monday to confirm this isn't anything of the sorts. It does look like we did have very solid volume and a very solid move off the lows. However, let's get a couple of more days of consolidation and momentum before we say, hey, this is the bottom or this isn't the bottom, because you can see in extended hours, we are looking a little bit red after the big move we did have. Nonetheless, the S&P 500 down 0.76 for the week. It was a down week, and looking year to date at all of the major gauges, we are still down, with the IWM down 8% here. And that is probably why it outperformed because it had underperformed going into this week. Relatively speaking, the Qs are the second worst performing asset, down just shy of 6%. The S&P 500 in the middle of the pack, down 3.7%. And the best performing is actually the RSP, so the broader market, the average stock, doing better than something like a large cap tech stock, only down at 1.18% for the year. Does look like we are putting in a bottom, but we do need a couple of more days of confirmation to confirm that. Equities are on the up and up. And if we actually have a look at what we did today, almost all of the major indices were up 2% on the day here on Friday. The S&P 500, the Nasdaq 100, even the RSP just shy of 2%. Mid caps, small caps, growth and value. A very positive day across the board. Volatility continues to compress. And now this is something we've been looking at a lot. When the spot VIX is higher than the front month VIX, it tells us that the volatility has an expiration date. And this is why we were somewhat expecting this. Now, I was expecting this volatility to compress not as quickly as it did today. I was expecting a compression closer to next week, mid next week. However, you can never nail the exact date and the exact level. It's impossible to do. It's why you have to work within ranges. But the spot volatility is still slightly higher than the front month contract. So we are still in an environment where near-term volatility is still slightly higher, and that can cause a little bit of concern next week. Yields did rise as a result today. The dollar did fall marginally. Bonds fell as a result. Bitcoin was up 3.7%, but with equities rallying, you're going to see that. And gold was flat, silver was flat, WTI gained ever so slightly. But let's actually dive into the S&P 500. And for those of you that have been following this channel for a while now, on this pullback, we've said that the buy zone where we really want to buy is this 4,500 to 5,500 area right here. This is where we actually want to go ahead. It's going to be our buy zone and we want to get long, potentially aiming for new all-time highs, but ultimately aiming for our first target here at the 5,700 area. Maybe we did front run this target a little bit. Maybe I was a bit too optimistic with that target, but like I said, it's almost impossible to pick an exact level. You sort of have to work within a range. This was the range, but I did say on this way down that you want to be adding to equities opportunistically at the pullback, at the 5% pullback mark, as well as at the 10% pullback mark. However, I'm not going to claim victory on a low just yet, because this could be a dead cat bounce. If we actually find resistance here, that would be at the gamma flip, and then we could actually make lows into next week. So what I really want to see next week is a retake of the gamma flip. If we go ahead and retake that gamma flip, we'd likely go to the 57.77 level, and then it does look like this will probably be the low. And then maybe my timing was off by a couple of days and my zone was off by 50 or so points. Nonetheless, this is very constructive. And I do think if we go ahead and retake this gamma flip on Monday, you want to probably get long on any pullbacks or just buy if we do go ahead and close above that gamma flip zone, because this right here is looking like a higher low relative to this low right here. So you put in a low, right? And yes, we did break some of these lows, but now we're looking like a higher low right here after a very healthy 10% correction. This is where you get long to go high. And if we close above that gamma flip zone, probably going to mean we go right to the 5,700 area. And then in very quick order, we would have rallied 4% from peak to that 5,770 area. However, what we first need to see is a close above the gamma flip, and that's what we're going to do on Monday. We want to see a close above the gamma flip, then we can determine the next move. If we don't get a close above the gamma flip, we obviously are still going to target our short-term 45.85, and then we may actually see trading in this zone right here. However, guys, I think you should definitely start opportunistically adding to your positions. I bought around about here. I added to my positions throughout the week this year. I actually added quite significantly to a lot of my positions, and this is where we are right now. However, OPEX is still the day I'm trying to look for a bottom, so we still have a whole week of volatility. Do be aware that the VIX, like I said before, near-term VIX, the spot VIX is still higher than the front month calendar VIX. Once we get that inversion, that's probably going to be another signal for us to move higher, and that'll probably mean we go even higher than the 57.77 area. However, for all of this to be relevant, we need to have a close above the gamma flip. Otherwise, our downside target is still 54.85. Ultimately, we are still in negative gamma and we're still aiming for that 54.85, even though we did go ahead and get it. Do be aware though, if you do zoom in, you can actually see right here, there was a number of wicks. These were tells that bulls were coming in. We were putting in a low right here in the S&P 500. The same is true for the NASDAQ 100. There was a number of wicks here near the put support zone, and ultimately the NASDAQ 100 actually closed in positive gamma. That's very interesting. And ultimately, this was the tell for us to get long. For those of you that did buy, best thing that you can do right now is simply hold your positioning, because I do think if the S&P 500 closes in negative gamma or in positive gamma on Monday, we probably will go higher through the week. Very, very good to see that we actually are starting to bottom at around our target range right here. It was a very, very good call to actually see this pullback to this range, making that higher low. And this is constructive for us to go higher, but we do need a lot of more confirmation first and foremost. Very positive here in the RTY as well. Still in negative gamma, but buyers did come ahead, buy the dip, and we did actually see a little bit of resistance at the gamma flip. However, very similar to the S&P 500, what we want to see is a move above gamma flip, and then we can have our next upside targets in the RTY. Gold officially hit the $3,000 mark, guys. We didn't quite get there yesterday. We did today, and you can see that this is our buy zone here for gold. We never ever got there because gold is really just that safe haven. It's that risk off trade that every fund manager's been going to because they're under allocated to it. And it's a great inflation hedge. It's a great tariff hedge, and it's had some very serious momentum in the last year. Over the last year, on a percentage return basis, gold is up 36%. Let's actually go ahead and add the S&P 500 and see what are the relative returns for gold versus the S&P in the last year. 8.91% in the S&P 500 versus 36% in gold. Complete outperformance, complete alpha generated in gold against most stock markets as a whole. Bitcoin, guys, for those of you that don't have it, you can actually go ahead and download my FinFluential Global Liquidity Money Supply Indicator. Hit the settings button right here. Just search FinFluential and you'll get it. Go 72. That's the time offset you need, right? 72 days is generally how long it takes for global liquidity to enter financial markets. You can see that this indicator, that Bitcoin tracks the supply of money offset by 72 days very, very quickly. So we are looking to put in a low right here in Bitcoin. This is going to coincide with equities. Now, this is not just for Bitcoin, guys. This is for equities as a whole, risk assets as a whole. We'll also see a huge boost from the amount of money supply that's coming in. This is mostly on the back of the Treasury General drawing down the TGA, as well as Europe bolstering up their defense budget, stimulus, China, rate cuts across the board. This is why we've seen a global liquidity increase so significantly. And as a result, within about the next 5 to 7 days, we should see this be a tailwind for Bitcoin and risk assets as a whole. So there's a ton of tailwinds right now, from earnings to data to certainty to global liquidity, that could definitely support risk assets as a whole. However, the actual bottom will probably come the 27th of March at or around that time period. Today is the 15th, so there is still about 10 or so days before we actually do see any material move in the money supply that will impact risk assets as a whole. That being said, I think we should really remain constructively bullish for the most part and look for confirmations in stuff like the S&P 500 above the gamma flip before making any bold decisions to get long in a material way. Nonetheless, today was very constructive for a move higher on a technical basis, a fundamental basis, as well as a news basis. And as long as there's no significant big news on the weekend, right, we can continue this momentum into next week. My advice, buy the dip. That's been my advice this entire pullback, particularly at the 5% range and the 10% correction range. Buy this dip, guys, and let's see where we go on Monday. And guys, let's look at sentiment. This is CNN's Fear and Greed Index. And surprise, surprise, we continue to remain in extreme fear as the S&P 500 this week has entered into correction territory. If you are a longer term investor, corrections are gifts from the market. This is really where you should be adding to your longer term positions, whether they be ETFs or single stocks. You really want to buy into the fear. However, we shouldn't discount the fact that extreme fear, if we do stay in this extreme fear zone, it probably will lead to elevated volatility and potentially even lower prices in the S&P 500. But when does a correction turn into a bear market? Corrections are drawdowns of 10% or greater. Bear markets are drawdowns of 20% or greater. And generally speaking, only 25% of the time do we see corrections turn into bear markets. 75% of the time, we don't get a bear market. So the super majority of the time, you should really just buy the 10% correction and call it a day. Since World War II, there have been 48 10% corrections, 12 turned into a bear market, so 25% of the time. We normally do see lower prices. However, the volatility that we have seen in the market here from about middle of Feb to where we are right now in March is historically normal. It's actually around about this time of year where we actually do put in a bottom in the S&P 500. We see a lot of volatility, a lot of pullback. Normally we do get a correction around about this time of year, and then we actually go ahead, put in a low, and then from there we actually make higher highs, higher lows into what normally is new all-time highs, and we actually see returns of about 9.72% for the average year. This is over the past 20 years. Generally speaking, you want to use about 30 years of data. 30 data points is what we would call statistically significant. So only using 20 years is a pretty thin pool of data, but data that we can use nonetheless, especially in the regime we've been in. So volatility we're seeing completely normal. And if we actually do put in a bottom and have a tactical bounce that could lead to higher prices, also expect that as well. This market has been incredibly resilient over the last 2 years. And while history doesn't often repeat, it sure does rhyme. And even in this pullback, the drawdown we're seeing in stocks has been purely sentiment based so far. The forward 12-month PE for the S&P 500 has compressed from about 22 times to about 20 times on a forward-looking basis. That's about a 9 to 10% contraction, while forward 12-month S&P 500 EPS estimates have actually ticked ever so slightly higher. In other words, what we really are seeing is just a re-rating of the overall market multiple. Maybe things got a little bit too frothy right here based on earnings estimates. However, if this trend does continue, where we see earnings estimates remain quite resilient and maybe even rise, and we continue to see the S&P 500 pull back, that is a big opportunity to buy. And retail has actually been taking advantage of the dip. Retail purchases of US stocks and ETFs have hit an all-time high levels going back to as far as November. Retail is buying the dip, taking advantage of this pullback. I am one of those retail buyers. I am adding, but I'm adding tactically at every 5% pullback. Can we go lower? Yes, we certainly can, but there definitely is some bulls out there. Ultimately, guys, what everything is going to come down to is the macro. And the truth of the matter is the macro data, the US economic data, is hinting at softer growth ahead. Consumer sentiment has actually plummeted from the highs we saw here in Jan. Changes in consumer spending is now in negative territory, and longer-term inflation expectations are rising. These are all hinting at softer US economic data. And at the end of the day, economic growth is the primary driver of S&P 500 EPS growth. If we do get softer growth, we're going to get slower earnings. And if we get slower earnings with where valuations are right now, we are going to pull back, or we're going to see a lot of churn and volatility in the markets. However, looking at some of the positives in the macro environment right now, so far this year, the total value of US IPOs is up 62%. The number of deals has nearly doubled to 63 from 33 during the same time period in 2024. And the value of 2025 IPO deals so far is on track to outperform the average year of the past decade, while the number of deals so far is higher. And we also may have a couple of big IPOs later this year. We're looking at stuff like Skims from Kim Kardashian. We're looking at stuff like Stripe. We're looking at stuff like Shein. These could all come to market further, especially with an easy regulatory environment. But what we need to see is stabilization in stock market prices. If we do get that, and maybe some momentum, that might even prompt more IPOs and by extension deal making in the market. Now, looking at data for next week, guys, the big focus is going to be on the FOMC. We also get the economic projections as well as the interest rate decisions. And then we get the Fed press conference on that day as well. So Wednesday is going to be all about the Fed. I mean, I don't even think a Donald Trump
headline is going to be able to derail this, especially with these economic projections. The market is very keen to see what the Fed is thinking. But before then, we get retail sales. The expectation there is for 0.5% growth, as well as building permits and housing starts. We're looking for 1.471 million and 1.34 million respectively. And then after the FOMC on Thursday, we have existing home sales, initial jobless claims, the Red Book Index, and all of the standard data points we get throughout the week. Looking at earnings, the biggest market cap on the schedule next week is Accenture. And guys, you do know that earnings season for this Q4 period is coming to an end when you see Nike, Micron, and FedEx start reporting. These are normally the back end of the earnings season. So in a couple of weeks, maybe a few weeks, earnings season will be over for Q4, and then we'll kick Q1 into gear. But for next week, we have Accenture, Nike, Micron, FedEx Corporation, General Mills, Lennar, Carnival Corporation, XPen, Tencent, FactSet, and that's about it in terms of high impact names. NEO as well, and then a couple of smaller mid-cap names. I'm seeing if I can, do I recognize any of them? Not really. So earnings season coming to a close, but definitely still some high impact names, especially in the semiconductor space, the consumer space, the software space, FedEx as well.